All right, let's talk about the VIX. What if I told you there's a single number, a gauge, right on the stock market's dashboard that tells you exactly how terrified investors are at any given moment? Well, there is. And today, we're going to master that gauge.
Let's just start with the single most important idea to get in your head about the VIX. It has nothing to do with the company's profits or its new product launch. Nope, it's a direct measurement of emotion. It is, quite literally, the price of panic.
Okay, why should you even care about this number? Because if you understand it, you can start to see market turning points before they happened. But first, let's get one thing straight. Who's actually pulling the strings behind this fear index?
Now, there's a common misconception we need to clear up right away. People think the Federal Reserve or some central bank directly controls the VIX. That's not quite right. The CBOE, that's the Chicago Board Options Exchange, they're the ones who own it and calculate it. But, and this is a big but, the real driver of its movement, that's almost always the central banks. When the Fed chairman even hints at a policy change, those words send shockwaves through the market that make the VIX jump or dive. So CBOE owns it, but the Fed moves it.
Okay, let's get into the good stuff. We are going to totally demystify this thing. Forget the complicated math. We're breaking the VIX down into 5 super simple, intuitive concepts. And I promise, in just the next few minutes, you're going to feel like an expert.
These 5 ideas right here, they're all you need. Think of them as your mental toolkit for the VIX. We've got the mood ring, the cost of insurance, the 30-day forecast, the traffic light, and the seesaw. Let's tackle them one by one. First up, the mood ring. This is my favorite way to think about it. The VIX is all about emotion. When that number is low, it means investors are feeling calm, maybe even a little lazy and complacent. But when it's high, oh yeah, that's pure terror gripping the market. It's a read on the collective feeling, not the facts and figures of a company. Second, think of it as the cost of insurance. See, the big players, hedge funds, pension funds, they buy things called options to protect their giant portfolios. It's just like you'd buy homeowners insurance if you knew a hurricane was on the way. And what happens when everyone rushes to buy insurance at the same time? The price goes through the roof. That's the VIX.
Third, and this is so important to remember, the VIX is not looking in the rearview mirror. It is not a history book. It's a crystal ball. It doesn't tell you how bumpy the ride was yesterday. It's the market's best guess of how volatile things are going to be for the next 30 days. It's all about the future.
Fourth concept, the traffic light. This is your quick and dirty guide to reading the number. So, if you see the VIX is below 20, that's a green light. It's signaling that markets are pretty calm, stable, probably just chugging along in a nice, steady uptrend.
Now, what if the VIX starts to creep up into that 20 to 30 range? Well, that's your yellow light. Time to be cautious. It means investors are starting to get a little nervous. Uncertainty is on the rise, and you should probably buckle up for some turbulence.
And when the VIX breaks above 30, that is a full-on flashing red light. Panic has officially entered the building. This is where you see those wild, gut-wrenching market swings of 2, 3, even 4% in a single day. Anything over 40 and you're in full-blown crisis mode.
And finally, our fifth concept, the seesaw. This perfectly captures the relationship between the VIX and the stock market. When the S&P 500 goes up, the VIX tends to drift down. But when the market crashes, the VIX shoots straight up like the other end of the seesaw. They almost always move in opposite directions. It's a beautiful inverse relationship.
Okay, so that's all the theory. Now let's get practical. How do you actually use this thing? We're going to look at 3 simple, actionable strategies. And it doesn't matter if you're a long-term investor, a short-term trader, or just a conservative saver. There's something here for you.
Let's start with the long-term folks, the buy and hold crowd. When everyone else is panicking, the VIX can give you a powerful signal to do the complete opposite. So the question is, how do you use that extreme fear to your advantage?
Just think back to March of 2020. The world was shutting down, and the COVID panic sent the VIX skyrocketing to an all-time high of 82. This was maximum fear. The headlines were terrifying, and pretty much everyone was dumping their stocks.
But a pro sees a VIX at 82 and remembers this classic advice from Warren Buffett. A VIX that high is a screaming billboard telling you that others are terrified, and that means stocks are basically on a fire sale. Historically, these moments of peak fear have been the absolute best buying opportunities of a generation.
All right, let's flip the script. What about you active traders out there? What if the market is the opposite of fearful? What if it's dead calm? Well, that calm is its own kind of signal. It's the calm before the potential storm. So imagine the VIX is just asleep, hovering around 11 or 12, super low. What does that mean? It means nobody is worried.
Investors have gotten complacent. They think stocks can only go up and nothing bad could possibly happen.
And here is the golden nugget. When nobody is worried, that portfolio insurance we talked about, it is dirt cheap. A smart trader sees this as a huge opportunity to buy that cheap protection because they know that any little surprise could cause the VIX to spike, making that insurance policy suddenly incredibly valuable. And last but not least, what if you're a conservative saver? You've got some cash, you're looking to put it to work, but you're not a risk taker. The VIX can be your best friend, telling you when the smartest move is to just do nothing, to just wait.
Look, if you glance at the market and the VIX is sitting at 35, that means the market is a raging storm. There are massive price swings every single day. Trying to put your money into that environment isn't investing, it's just gambling. The smart move is to keep your cash safe on the sidelines and wait for the VIX to fall back below 20, telling you the storm has passed.
Okay, before we wrap this up, I have to give you one really crucial warning. This is, without a doubt, the biggest and most expensive mistake I see new traders make when it comes to the VIX.
So many people try to invest in the VIX by buying products like VXX or UVXY and just holding on to them for the long term. This is a massive, massive mistake. These products have this nasty little mathematical feature called contango, which is a fancy way of saying they are designed to lose value over time. They're like a melting ice cube. They are tools for very short-term trades, not investments. Please remember that.
So there you have it. The VIX is the market's own alarm system. It tells you when fear is cheap and when it's expensive. And now that you know how to read the price of panic, the only question left is, what is it telling you right now?